Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's kick things off with Far East Orchard, a Singapore-based investment holding company that's making waves in the student accommodation space. If you're not familiar with them, Far East Orchard operates in three main segments: management services, operations, and property ownership. They develop residential, commercial, and hospitality properties, with a growing focus on purpose-built student accommodation, PBSA. The big news is that Far East Orchard just announced they're acquiring a purpose-built student accommodation site in Manchester, UK, for $10.9 million, about $19.1 million. This marks their first entry into Manchester, which is a major university city in the UK. The 275-year leasehold site will be developed into a 239-bed PBSA property and is expected to be completed in 2028. What's interesting is that this acquisition brings Far East Orchard's portfolio of existing and pipeline PBSA assets to over 4,100 beds. The company is clearly doubling down on student accommodation as a key growth strategy. The buyer, Plymouth Grove Development Limited, is a subsidiary of Far East Orchard, held through a partnership with the private student accommodation development fund FASAD, which was established just last year in August 2024. Looking at the numbers, the total development cost, including the purchase price, is estimated at around $47.0 million. Far East Orchard holds a 50% stake in this Manchester development through FASAD, with Wohup Holdings holding 21.4% and an unrelated third-party investor holding 28.6%. Far East Orchard CEO Alan Tang mentioned that student accommodation is a key pillar in their strategy to build a resilient lodging platform with sustainable recurring income. This makes sense given the steady demand for student housing in major university cities. As for their stock performance, Far East Orchard closed at $1.03 yesterday, down 1% or 1 cent before the announcement. Looking at their valuation metrics, they're trading at a PE ratio of 8.5x, which is below the sector average of 13.0x. Their price-to-book ratio stands at 0.4x, also below the sector average of 0.9x. These numbers suggest the stock might be undervalued compared to its peers. The company's focus on building a portfolio of student accommodation properties could provide a stable income stream, especially in markets like the UK, where there's consistent demand for quality student housing. This acquisition isn't expected to have any material impact on their earnings per share or net tangible assets per share for the current financial year ending December 31st, 2025. Next up, let's talk about BYD, the Chinese automotive giant that's making significant strides in the electric vehicle market. BYD trades on the Singapore Exchange as a Singapore Depository Receipt, SDR, under the ticker HYDD. For those who aren't familiar with SDRs, they allow investors to trade foreign stocks on the local exchange. BYD was founded back in February 1995 and has grown into a high-tech company focused on electronics, auto, renewable energy, and rail transit. They've completely pivoted to new energy vehicles, having discontinued production of internal combustion engine vehicles in March 2022. The company has been making headlines with its expansion plans. According to recent reports, BYD is planning to increase its sales network in South Korea from 15 to 30 locations by the end of this year. This is part of their broader strategy to boost deliveries outside of China. Liu Shuiliang, the general manager of BYD's Asia-Pacific auto sales division, made this announcement at the Seoul Mobility Show in Ilsan City on Thursday. BYD has set an ambitious goal of selling around 5.5 million vehicles this year, which shows their confidence in continued growth. To put this in perspective, they sold about 3 million passenger new energy vehicles in 2023, accounting for 33% of the Chinese passenger NEV market. Looking at their stock performance, the BYD Singapore Depository Receipt closed at $6.49 on Thursday, down 1.4% or so 9. The underlying stock in Hong Kong, ticker 1211HK, was trading at H260.40 SUS as of the last available data. From a valuation standpoint, BYD is trading at a PE ratio of 24.32, which is higher than some of its competitors like Li Auto at 20p11. Their price-to-book value is 4.94, and price-to-sales is 1.09. These metrics suggest that investors have high growth expectations for the company. What's particularly impressive about BYD is their return on equity, ROE, of 23.24%, which is significantly higher than competitors like NIO, which has a negative ROE, and Li Auto at 17.88%. This indicates that BYD is more efficient at generating profits from shareholders' equity. Last but certainly not least, let's dive into Overseas Chinese Banking Corp, or OCBC, one of Singapore's oldest and most established banks. Founded in 1932 through the merger of three local banks, OCBC offers a comprehensive range of financial services, including consumer banking, wealth management, private banking, business banking, and insurance through its majority-owned subsidiary, Great Eastern. The big news for OCBC is that its private banking arm, Bank of Singapore, is planning a significant expansion of its Greater China team. They're looking to add between 20 and 30 relationship managers this year, which represents a substantial investment in one of the world's major wealth centers. According to Ricky Chan, who oversees Bank of Singapore's Greater China market, financial activities in Hong Kong are picking up, and more high net worth individuals are looking to keep their assets with a Singapore bank. His Hong Kong-based team aims to boost client assets by an impressive 50% by the end of 2026. This expansion comes at an interesting time for the wealth management industry in Asia. With Hong Kong's financial activities rebounding and Singapore continuing to establish itself as a wealth management hub, OCBC seems well positioned to capture growth in this segment. Looking at OCBC's recent financial performance, their third quarter 2024 earnings came in at $197 billion, exceeding analyst estimates thanks to a surge in trading income and higher fees and commission income. Their net interest income grew 2% year-on-year, driven by loan growth of 2%, though this was partially offset by a slight dip in net interest margin of 6 basis points to 2.20%. OCBC's stock closed at $17.20 in recent trading, which is about 4.07% below its 52-week high of $17.93 set on February 19th, 2025. The stock has shown solid performance over the past year, with its 52-week low being $13.47 from April 17th, 2024. From a valuation perspective, OCBC is trading at a PE ratio of 9.32, which is slightly lower than DBS at 960, but higher than UOB at 917. Their price-to-book value stands at 1.20, which is lower than DBS at 167, but comparable to UOB at 121. These metrics suggest that OCBC is reasonably valued compared to its local banking peers. What's particularly attractive about OCBC for income investors is its dividend yield of 5.65% based on trailing dividends, with a forward dividend yield of 5.78%. The next dividend ex-date is coming up on April 25, 2025, with the payment date set for May 9, 2025. Looking ahead, analysts expect OCBC's fourth quarter 24 earnings to grow by approximately 21% year-on-year, driven by double-digit fee and trading income recovery with stable provisions. Net interest income is expected to remain relatively flat. That wraps up today's Singapore Market Digest. I hope you found this analysis helpful for your investment decisions. Remember, the market is always changing, so stay informed and invest wisely. This is Iggy from the Investing Iguana, signing off until next time.